and welcome to the channel. For those of you new, my name is Dave and I work in financial services, and these videos are mixed into it towards financial freedom, financial well-being, financial products so you, like me, can reach your goals sometime in the future. Now let's get into the latest video. Now this video is about my individual savings account for the review of April 2024. Now it's not to boast or brag or say look at me, but it's to say to people, well, I've built a sizable portfolio, so can you too. If you take some plans, you take some action, and you create an action plan. So let's dive into what the aims of the portfolio are. Well, we're looking for annual growth year on year of 10%. For 2024, we're looking for annual dividends of £3,600, and we're looking for a year-end value of around about £113,000. How was the portfolio done during the month? Well, the start of the month it was worth £105,868,000. End of the month it was worth £106,799,000. So an increase in the month of £931. Now year to date we're up 8.7%. UK, the FTSE's had a very good month. The FTSE's up 5.6% year to date. Contribution during the month we paid £284. So for the year we've paid nearly £9,000, and our platform provider charges fees of £14.97, which is about average. It's a percentage of our portfolio valuation. Let's see whereabouts our portfolio is held. So UK based is 59.73%, USA and Americas is 27.26%, Asian emerging markets is 13.01%. So during the month we received £427.93, year to date £509.04 against expectations of £1,200. So we're about £700 short, but we will have a very good month in May, so we will be back on some kind of track. So what dividends we received during the month? Well, Barclays gave us £84.16. We reinvested and we got 43 new shares. HSBC gave £122.90 as a quarterly dividend. We reinvested, we got 18 shares. Our China fund gave us £17.42, which was reinvested in accumulation units. And our Fidelity World Index fund, giving us a yield of about 2%, gave us £93.40. So a very good month, but our best month to date. Dive into portfolio. Now these are my own recommendations. They're all what we call long-term holds. We've got no reasons why to sell them anyway, but it's not financial advice. They're my own personal opinions. Remember, if you like the videos, smash the like button, subscribe to the channel. So let's look in the portfolios in more depth. Now with our shares, we own 10 shares, 6 in profit, 4 in loss. Makes up 45% of our portfolio, £48,152, of which 39% is in the FTSE 100 and 6% is in the FTSE 250. Predominantly based, shall we say, financial services, what we know about, and UK companies. So our largest holding is Lloyds, the banking group. 19,189 shares, nearly £10,000, 9.41% of our portfolio. Had very good results recently, is very cash rich, given a yield of about 5%, and it will pay us a nice dividend next month in May. Legal & General, the insurance company, we own 3,957 shares, £9,400, 8.7% of our portfolio. Has had a poor run recently, has been affected across the insurance sector. It was our bigger holding, but it is given a yield of around about 9%, which will be paid in June. We also own Aviva, another insurance company, 1,774 shares, £8,000, nearly 8% of our portfolio. Has struggled just like L&G, but given a very nice yield of 8%, which will pay at the end of May. Our next holding is away from the banking sector. It's Card Factory, 3,738 shares, £4,000, nearly 4% of our portfolio, but it has had a very good month. Trading results were out. Revenues were up 10% year on year. Pre-tax profit went from 52 to 64 million. The net debt went from 54 down to 34 million, and as a result, the dividend was reinstated, so 4.5p will be paid in June, so a nice surprise, but a yield of over 4%. Back onto the banking shares, we own HSBC, 495 shares, £3,500, 3.4% of our portfolio. It was done away from the UK market, but it does get a very good dividend on a quarterly basis, and it will pay a special dividend in June. We also own Barclays, 1,631 shares, £3,000, 3% of our portfolio, giving a yield of 5%, and NatWest, 992 shares, £3,000, 2.8%, but it will be interesting what happens with the impending sell-off. When will it happen, and what price will the shares be at, and what will that affect the price of the company moving forwards? We own AJ Bell, the platform provider, 724 shares, £2,300, 2% of our portfolio, what we see as a growth stock. People are investing online. It does pay a small yield, but it is growing customers, and profits are growing year on year. We own Sainsbury's, the retailer, 881 shares, £2,300, 2.2% of our portfolio. We're very cash rich, and recent results are out, dividends has been maintained. But it is, shall we say, some kind of recovery play within the food sector. And then finally, Phoenix Group, the pensions provider, has been on a buying spree lately, buying up old companies, shall we say. We own 421 shares, £2,000, 2% of our portfolio. Has struggled, shall we say, like Aviva and LNG, but it will pay a very nice yield of around about 10% in the next few weeks. Predominantly, shall we say, financial services, all in the UK, but it's what we know about. We're going to keep them shares for the foreseeable future. We've got no plans to sell any of them shares, what we call long-term holds. But remember, they are my own personal opinions. Now let's look at the funds we hold in the portfolio. At the moment, we own 10 shares, 5 in profit, 5 in loss, makes up 55% of our portfolio. Fund values collectively is £58,444. Now we have tried to simplify funds, and we will do moving forwards to more passive funds we can just switch off. They will track the market. So our largest holding is a passive ventures fund through our platform provider, £22,500, 21%. We just switch off, it covers numerous bases. We own a legal and general technology fund, nearly £12,000. 11% of our portfolio had a great run in 2023, struggled in 2022, but it owns, shall we say, the top 300 funds, predominantly based in the USA. We can done for a reason, and very good results, shall we say, prior to recent weeks. One fund we've been topping up lately is the Fidelity World Index. Again, covers the market for £8,000, nearly 8% of our portfolio. It did give us a good annual dividend at the end of April, and it has got low fees of 0.12%, so it will be a fund we increase moving forwards. Now, some funds that have struggled are Fidelity China Fund, £2,500, 2% of our portfolio, an emerging market fund, £1,800, 2% of our portfolio nearly, and a mid-cap fund of £800, 1.5%. We also own a second emerging market fund of £1,800, and our smallest fund is a Russia fund. We put £500 in, it went up to £600 plus, and then struggled ever since, and it's now at £270, but thankfully it makes up 0.25% of our portfolio, so a tiny percentage. We're not going to sell at a loss, but who knows what will happen with the so-called Russia-Ukraine conflict. Now, one thing we have done recently, we've set some side money away for a particular purpose. So we've created two funds to ring fence them. We own an S&P 500 fund. We put 3,000 in, and it's still worth £3,000, but 2.8% of our portfolio. And we own an FT All Share World Index fund, £5,300, 5% of our portfolio. But again, it was done just to track the market, but it's done there for a particular reason. We're ring fencing it for a specific event in future, but we didn't want to add it to our existing funds. With the funds though, we may well, shall we say, sell some recoveries. When the emerging market funds, China fund, mid-cap funds get back in profit, we're going to put them into our, shall we say, Fidelity World Index fund or a passive fund. One, to save fees, save charges, but two, to save the administration on the number of funds we're going to hold. Remember, it's not a get-rich-quick scheme. Okay, we will have good months, we will have bad months, but the idea is we're going to create, or hopefully gain, 10% year on year, and all dividends will be reinvested to grow the portfolio. but they're all done within a tax-free offer. So all growth is tax-free, all dividend tax-free. There's no need to declare, there's no need for self-assessments, but it's more to prove. If I can build a portfolio of 6 figures, so can you.